And thank you so much for joining us here at Empower 24. It's great to have you here, and you are speaking on a panel obviously focused on private credit. So let's just start by looking at that and how are rising rates really impacting the opportunities in that space.
Yes, of course. And floating rate is one of the most attractive features about private credit. These instruments are largely senior secured and floating rate. And so when you're in times of interest rate uncertainty, or more recently, in times of rising rates, investors in that space have benefited from that rise as the debt instruments reset on a quarterly basis to the prevailing rates. So not only is that offering really attractive levels of yield and coupon in this environment, but you've also been spared of the interest rate duration risk that you saw in a lot of more traditional fixed income investments.
So are there any parts of the market that you would say are facing greater challenges than others? And if so, what are they and how do they manifest?
Sure. Well, floating rate is a double-edged sword. So you benefit from rates rising, but as an investor, you want to avoid situations where there's so much interest expense on the companies that they might thereby default. Fortunately, the markets remained quite healthy, and default rates in both the US and European landscape have remained relatively low. And because of that, investors have not only benefited from the high levels of coupon in the market, but they've been able to do so in a fundamentally attractive space.
So nothing that's been perhaps too alarming or unpredictable in that sense, but there are other external outside factors that are going to have an impact in both in terms of economics, but also the geopolitical perhaps. So you've got to be fairly nimble and robust.
Yeah, of course. There are some pockets of the market that have experienced challenge, just given that as rates are rising, some borrowers have struggled to keep pace with the payment of those coupons. But those have been quite concentrated in small segments of the market where maybe borrowers were over levered or having too much debt. But by and large, the borrowing base in the corporate loan space remains quite healthy today.
And so your view is very positive about the quality of the deals that are being made.
Well, the deals being done today are particularly attractive. If you think about looking at those loans that are being issued on a new basis, the leverage, the loan to value, related to the levels of income that you're generating at historical highs, that's a really attractive risk-adjusted return proposition for investors, and the relative value is particularly attractive as well.
Absolutely, talking about that, the relative value of private credit and other areas of private markets as opposed to the public.
Yeah, it's been an area of broad focus, and one that I'm excited to see as it expands to offer access to more investors. But not only do private markets offer return opportunities in the form of liquidity premium and inefficiencies, but credit in particular has been an area of focus as credit has become a more attractive place to be as rates have risen, and the relative value of being a credit investor is that you're getting paid more than you previously did. And so when you look at private credit strategy versus, say, a private equity strategy, the return opportunity on a relative basis has improved for private credit investors.
So just finally, what would you say categorises what is a realistic expectation in those terms of what you've just, all the stuff you've just talked about in terms of what is the higher return that's possible through private credit?
And that's one of the beauties of the space today, is that there's really attractive entry points for investors with a range of different goals. For income-oriented investors, there's attractive spaces of the private credit markets that have more liquidity for investor, and those can be, offering 8-9% type yields in this environment. And then for investors who want to continue focusing on income but don't need as much liquidity, they can focus on parts of the market that offer that liquidity premium that can be, 1 to 200 basis points higher than that, and delivering really an income-oriented profile. And then the area that you're alluding to is that there's been a growth of opportunities in the high return space of credit. And those can look more like equity returns, which on their own are quite interesting. But if you look at the deals that we're seeing today, particularly in the more inefficient parts of the market, not only are you able to target high equity-like returns, but the actual risk profile you're undertaking is far lower than you've historically seen. And as a standalone consideration, that would be attractive on its own merits. But this is in a time where a lot of the traditional high return strategies like private equity or the like are facing more uncertainty and more headwinds than than previously, and that's drawing a lot of interest to the opportunity.
I guess people have got to work a little bit harder for that return than they used to. Raman, thank you so much for joining us.
My
It's been
pleasure.
great to hear your insights. Thank you.